Welcome to Chapter 2, Part 1 of 2. I try to keep my videos less than 15 minutes, so I might have to, that'll look weird. I might have a Part 2 of Part 1 of 2 video tutorial, but anyway, we'll see what happens. So I'm not going to read the objectives, and in the last video, by now in your readings, you should be familiar with what we mean by asset, liability, equity, revenue, and expense. Let's practice. Let's see if we can identify an account and determine if that account is an asset, liability, equity, revenue, or expense. And I've already filled these out. I probably shouldn't have already. You don't have the answers on the class notes. But anyway, let me show you something real fast. Real quick trick. All right. A lot of times the answer's in the name. Pretty cool, huh? So service is revenue, is a revenue account. Salaries expense is an expense account. So really, we don't want to see you missing these, okay? You should be able to get those correct, right? So out of 14 listed here, just for the example here, 1, 2, 3, 4, 5. Almost half, not quite, but almost half we've eliminated, and you can quickly identify what they are because the answer is in the name. All right, so here's another cool trick. Anytime you see the word payable, that's a liability. Liability. So interest payable means we still have to pay it. It's a payable. It's our payable. We're going to eventually have to pay it. So it's a payable. So that's just how you have to remember it. Basically, is we owe it. We're going to pay it. It's a liability. It's a payable, and those are synonymous. Liability, payable. In my opinion, they're just synonymous words. All right. So let's look for more liability since we're on it. So that was the only one on this list. That's cool. So obviously, if it ends in payable, it is a liability. We'll be adding to this list. This isn't an exhaustive list. It does grow over time. However, this is a great example to start with. All right, so let's look at assets next. Accounts receivable. We eventually will be paid. Somebody owes us money. We will receive the cash in the future. So that's an asset, right? It's like an IOU. Somebody else owes us, and we'll get the money in the future. So at a bank, your car loan to a bank is just an asset. To you, it's a debt. All right. So interest payable to us, this company, is a liability, but the bank is an asset. So accounts payable. I worked for a lender forever. I was almost ready to say interest receivable as soon as I started thinking that. All right. So accounts receivable is an asset. Obviously, equipment, if the company owns equipment, copier or machinery to make stuff with, equipment, that's an asset. Buildings, obviously, is an asset, and I know I skipped one. Prepaid insurance. If you were to pay your car insurance for the whole year, you wouldn't have to pay it again for the rest of the year, right? Well, that means every month you're not paying insurance. Some of y'all probably pay insurance every month, maybe quarterly. Maybe somebody listening to this video pays it once a year. If you paid it for once a year, every month, instead of making a payment on your insurance, you're not. So it's kind of like an asset. At least that's how we treat it in accounting. So prepaid, we paid the whole year up. Insurance is an asset. Talked about the items in yellow already. Dividends, love a dividend. I got dividends coming in. I own stock in a company. And this particular company, different stuff, most companies wire or put the money in your account or however electronically. This particular company mails it still. It's just a glorious thing. I don't know why I like it. I wish it would. I hate it. I hate having to go to the bank. But anyway, but they mail the check. And it always comes on June. It's here either the day before or right on June 1st. And either the day before or right on December 1st, right? So dividends. Well, anyway, dividends are equity, all right? Dividends are equity. Office supplies, some of y'all probably work in bookkeeping or accounting already, and there is no office supplies asset account. I work for a bank. or a mortgage company, we did not have office supplies as an asset account. We expensed it as soon as we bought it, but we didn't buy a lot. We bought a very little amount. Office supplies, and I just went rugshot over the whole explanation reasons. So that was not a complete explanation reason for why we didn't have office supplies asset account, only office supplies expense. But office supplies for a lot of companies are an asset. All right, just imagine a skyscraper full of a company's business, right? 30, 40 floors, 50 floors. They're buying copy paper by the truckload. There isn't somebody that runs around the corner to, Office Depot or Office Max, whatever's around now, Staples or whatever, and just buys a couple of reams of copy paper and comes back to the office. They're bringing tractor trailers backing up and they're unloading pallets of copy paper. Office supplies, assets. So in these classes, we're going to treat everything as just, the way it should be in GAAP accounting, no exceptions, just perfect. In the first video, I said there's generally accepted accounting principles. There are times where a company would need office supplies, okay? If a person had a small tax company, do a few taxes a year, maybe $10,000, $20,000 worth of revenue a year, they might not have any office supplies as an asset. They buy just enough paper. It's immediately put into use. In other words, the case of paper or the ream of paper is opened up immediately and put into use. There's no storage for that. There's no asset. We're going to have office supplies asset, okay? And you're probably wondering, where did all that come from? He's trying to keep his video short. I know, but I know there's a problem here, and I don't have y'all in front of me if I'm doing this video, so I tried to cover everything for everybody that I can think of. Common stock is equity. So let's review equity. I'm going to put it in a different color because I think it's helpful to really look at equity. All right, so we have 3 equity accounts here. Retained earnings, if you will, just pretend that's like a savings account for a company. They deposit revenue, their profits, and if they have a loss that year, they pull it out like a withdrawal out of a savings account. Sometimes the owners, corporation have owners, small businesses have owners, they want some of that profit, that money taken out of that retained earnings, or if you will, the way I'm presenting this is a savings account. So then dividends are paid to the owners. That's like a withdrawal. Common stock is like the owners saying, you know what, I want to invest more money into my business. So they put more money into their equity. So if you look at it that way for those 3 equity, I think it'll help you remember what goes where. All right? Enough of that. Let's move on. We need to always make sure that our debits equal our credits. Debit on the left, credit on the right. Debit, DR, credit, CR, debit on the left, credit on the right. All right. So what we'll do is we'll add up the total of all our debits and add up the total of all our credits, and we want them to equal each other. So in this scenario, this isn't something you got to work through. This is just an example. In this scenario, A will equal B. Okay? A will equal B. Just to give you a heads up. Now, I love T accounts. All right? Love T accounts. I once was a friend of mine owned very wealthy. Anyway, but he owned his own CPA firm, and I went in, it's the type with the cufflinks and, the shirt that costs more than most people's pants, that type of office attire. He's sitting there and he had T accounts on a legal pad, right? And I always thought after that, I don't know if T accounts were good enough for a partner and an owner of a large CPA firm, making oodles of money. If it's good enough for him, it's good enough for everybody. So love T account. I already loved them, and that just affirmed it in my mind. General journal, T accounts. All right, so let's do our first general journal. All right, now we're just going to do it. We're going to walk our way through it. We'll take our time. Record the purchase of a building, $200,000 in cash, and issue $800,000 note payable. Now, what I say about payable is always liability, so that's debt. building asset. You might want to review this several times, because you want to think as you do these, is that an asset? Is that a liability? Is that equity? Okay. This is an example of a compound entry. In other words, we're going to have more than one credit or more than one debit. All right. So purchased a building, they paid $200,000 cash, and they borrowed $800,000. So they paid $1 million for the building, right? 200 plus 800. All right, so you probably see it there. I didn't do a good job of covering it, did I? So we debit the building for $1 million. We record cash and the payable just as shown in the problem. All right, so when you have to do a journal entry in this class, you'll be given this information. You want to create it, you want to come up with it. Same thing in the real world. You know, as a bookkeeper, they say, hey, we bought a building. Here's the information. Here's the deeds. And you fill out the journal. All right, so debit building, credit cash, credit notes payable. And again, let's make sure we highlight this. Debit, 1 million. Credits add up to be $1 million. 200 plus 800,000 is $1 million. So our debit equals our credits. If this had just been one debit and one credit, that would be a simple journal entry. But because we have more than one credit, it's compound. If we had more than one debit and just one credit, it would still be compound. Compound is just fancy for saying we got more than one debit, or we got more than one credit, or we got more than one debit and more than one credit. Whew, that got me dizzy saying that. That was just crazy. Anyway, but you can always rewind this video. All right, so let's look at this in T account form. So we got accounting name, whatever we're going to call it for the building. We can say Aiken Building, right? So we had a debit here. And in the T account, still debit's on the left, credit's on the right. $1 million for debit, and this line means totals $1 million. Okay. Asset. We've got a new line here. We'll talk about that in a second. We credited cash, $200,000. Liability, we credited $800,000. Keep it on the right, $800,000. And there was no change in equity. And I want to highlight this very important conversation. Do not expense a building in GAAP accounting. That is a long-lived, some people say long-lived. It's kind of like tomato and tomato, pecan and pecan. Depends on who you get. I like to switch it around because I like saying both of them. But long-lived asset, in other words, it's going to last a long time. Think about the schools and the buildings you've been in and the houses you've been in. Some of them have been around a long time. They last a long time. Therefore, we cannot expense them the day we buy them or build them. We expense them over time. Conversation for another day. Just remember, when you buy it, don't expense it. You put it in a building account as an asset, no expense. Do you see any expenses here? The answer is no, you don't, because we don't expense it when we buy it. There's another method for expensing. Okay, so all those T accounts, and you saw normal, and you saw increases, and you saw decreases, right? Well, we got a little learning tool here. ADE clear. AD clear. Assets, dividends, and expenses are debited, and those increase debits. Credits are decreased with CLR, not the cleaner. CLR for us is contributions or investments when people buying stock, liabilities, and revenues. All right. Asset, dividends, expenses, those accounts go up. Left side, clear. Right side, that's what causes those to go up. Contributions, liabilities, and revenues. Okay. I see the video time is about to expire, so we are going to have a second part for this video. What we'll do is we'll pick up here in the next part.